Good morning. We are talking of sources of credit, short term credit, commercial paper. Another source of raising short term funds by highly rated corporate borrowers for working capital purposes. The Reserve Bank of India has issued guidelines for issuance of CP as follows: CP commercial paper. Eligibility to issue: the minimum tangible net worth of the company is rupees 4 crore as per the latest audited balance sheet. The company has fund-based working capital limits of not less than rupees 4 crore. The shares of the companies are listed at one or more stock exchanges. Closely held companies whose shares are not listed on any stock exchange are also permitted to issue commercial papers provided all other conditions are fulfilled. The company has obtained minimum credit rating from a credit rating agency, that is CP2, from CRISIL, Credit Rating Information Services of India Limited, 88 from ICRA, Investment Information and Credit Rating Agency, or PR2 from CAR, Credit Analysis and Research. The commercial paper may be issued by the companies on the basis of certain terms and conditions. The amount for which the companies issue commercial paper is to be carved out of the fund-based working capital limit enjoyed by the company with its banker. Procedure for issuing commercial paper: the company which intends to issue commercial paper should submit an application in the prescribed form to its bankers or leader of the consortium of banks, together with a certificate from an approved credit rating agency. The rating should not be more than 2 months old. The banker will scrutinize the proposal, and if it finds the proposal satisfying all eligibility criteria and conditions, shall take the proposal on record. Thereafter, the company will make arrangement for privately placing the issue within a period of 2 weeks. Within 3 days of the completion of the issue, the company shall advise the Reserve Bank through its bankers the amount actually raised through CP. The investor shall pay the discounted value of CP through a check to the account of the issuing company with the banker. Thereafter, the fund-based working capital limit of the company will be reduced correspondingly. Intercorporate loans. Short-term finance for working capital requirements of a company may be raised through accepting intercorporate loans or deposits. Some companies which may have surplus idle cash due to seasonal nature of their operations or otherwise would like to lend such resources for such period when they are not needed by them. On the other hand, some other companies face financial stringency and need cash resources to meet their immediate liquidity needs. The provisions have been made for intercorporate loans and guidelines issued from time to time in this regard. Bonds and debentures. Bonds and debentures are another form of raising debt for augmenting funds for long-term purposes, as well as for working capital. These debentures may be fully convertible. Fully convertible means fully convertible into shares, equity shares, partly convertible or non-convertible into equity shares. The Securities and Exchange Board of India, SEBI, controls the issuance of bonds and debentures in India, and for this it has issued guidelines which have been revised from time to time. Factoring of receivables. Factoring of receivables is another source of raising working capital by a business entity. Factoring is an agreement under which the receivables arising out of the sale of goods or services are sold by a firm called the client to the factor, a financial intermediary. The factor thereafter becomes responsible for the collection of the receivables. In case of credit sale, the purchaser promises to pay the sale proceeds after a period of time. The seller has to wait for that period for realizing his claims from the buyer. His cash cycle is thus prolonged and he needs larger working capital. Factoring of receivables is a device to sell the receivables to a factor who pays the whole or a major part of dues from the buyer immediately to the seller, thereby reducing his cash cycle and the requirements of working capital. The factor realizes the amount from the buyers on the due date. Factoring is of two types, with recourse and without recourse factoring. Factoring business may be undertaken on with recourse or without recourse basis. Under with recourse factoring, the factor has recourse to the client if the receivable purchase turn out to be irrecoverable. In other words, the credit risk is borne by the client and not the factor. In case of without recourse factoring, the factor does not possess the above right of recourse. He has to bear the loss arising out of non-payment of dues by the buyer. The factor therefore charges higher commission for bearing this credit risk. Now the next part of today's counseling, working capital management, issues and practices. Working capital management in SMEs. To define small and medium enterprises, academics and policymakers employed a range of criteria, including total worth, relative size within the industry, number of employees, product value, yearly sales or receipts. The benchmarks, on the other hand, differ significantly from country to country. Small and medium enterprises versus large companies. Small firms are similar to large, well-established corporations, but they have a lesser market presence. On the other hand, the larger firms must deal with a plethora of rules and regulations that they have imposed on themselves. As a small business owner, you will have a lot more leeway when it comes to making adjustments to business processes. Taking working capital management seriously and paying attention to the intricacies of how cash flows are handled can make the company more lucrative. This, when paired with social networking E-commerce and data science can be extremely beneficial to small businesses. The following distinctions in working capital management techniques exist. For short-term finance, there is growing reliance on trade credit and bank overdrafts. Willingness to extend overly generous credit terms to win business, especially from large corporations. Weak control procedures and a lack of clear working capital management policy. The manufacturing and retailing firms generally hold more than half of their total assets as current assets, many of whom do not have long term assets such as a building or a vehicle of their own. The small firms most typically pursue finance in the form of standard small business loan. In addition to standard small business loan, they may be able to obtain funding through personal loans, such as home equity loans. Small businesses can also fund their endeavors through their vendors. Role of small and medium enterprises. Small and medium enterprises contribute significantly to the creation of jobs and the gross domestic product of all countries across the world. Not only in India, all over the world, they are the main source of creation of jobs and GDP. These in general engage in a wide range of economic activities and are often regarded as the backbone of economic growth and development in both emerging and established economies. Small and medium sized businesses are one of the most active development engines, accounting for about 80% of worldwide economic development. SMEs account for more than 90% of business in developing nations except agricultural businesses, and they contribute significantly to GDP. As a result, practically every country considers SMEs to be a priority. Role of small and medium enterprises in India. In India, this industry contributes considerably to the socio-economic development of the country. Furthermore, compared to larger corporations, it offers a big number of job prospects at a minimum capital cost. Small businesses are predicted to have a fourfold higher employment intensity than large businesses. As supplementary units, these small businesses are also beneficial to the larger industries because of their effective, efficient, adaptable, and innovative entrepreneurial nature. They also contribute to the development of the home economy. Furthermore, they aid in the reduction of regional imbalances by assisting in the industrialization of rural and backward areas. Similarly, the SME sector ensures that national income and wealth are distributed more evenly. Small businesses have succeeded in achieving the socialist objective of delivering equal growth. Even though huge corporations generally generated the island of affluence in an ocean of poverty. SMEs in India are defined differently for businesses that manufacture, produce, or process items versus those that provide or deliver services. Manufacturing businesses are classified their investment in plants and machinery, whereas service businesses are classified their investment in equipment. And overall, they are also classified as per the turnover. This classification is according to MED Act of 2006. The classification is in case of manufacturing sector. The SMEs have been classified into three parts: micro enterprises, small enterprises, and medium enterprises. And their classification is based on investment in plant and machinery as well as annual turnover, or you may say whichever is less. In case of micro enterprises, investment in plant and machinery should not exceed rupees 1 crore, or you may say the investment in plant and machinery should be up to rupees 1 crore, whereas the annual turnover must be up to rupees 5 crore. Means there are two limits, and as they are the limits, you may say whichever is less. If the investment exceeds 1 crore and turnover is less than rupees 5 crore, even then this will not be micro enterprise, it will become a small enterprise. And vice versa. If the investment is up to rupees 1 crore but turnover exceeds rupees 5 crore, then again it will become a small enterprise. In case of small enterprises, investment in plant and machinery should be between rupees 1 crore to rupees 10 crore, while the annual turnover should be rupees 5 crore to rupees 50 crore. For the medium enterprises, the investment in plant and machinery should be between rupees 10 crore and rupees 50 crore, while the annual turnover should be between rupees 50 crores to rupees 250 crores. In case of service sector, the basis of classification is investment in equipment as well as annual turnover. For the micro enterprises, investment in equipment does not exceed rupees 1 crore, or in other words, you may say up to rupees 1 crore, and annual turnover up to rupees 5 crore. If the investment in equipment exceeds rupees 1 crore but does not exceed rupees 10 crore, or turnover exceeds rupees 5 crore but does not exceed rupees 50 crore, then the enterprise will be known as a small enterprise. If the investment is in equipment more than rupees 10 crores but does not exceed rupees 50 crore, or and annual turnover is between rupees 50 crores to rupees 250 crore, then it will be known as medium enterprise. Working capital management in SMEs. Unique characteristics. Many small businesses do not maintain proper accounting records for their operations. As a result, without proper accounting records and information, SMEs have a difficult time distinguishing between their working capital and earnings. As a result of this issue, SMEs frequently fail a few years after they are founded. As a result, the goal of working capital management is to keep net capital at a level that maximizes the wealth of the firm's owner. Apart from that, there are several other problems to consider when it comes to the working capital management. The first problem is effective working capital management ensures that the firm has sufficient liquidity to meet its short-term obligations when they become due, as well as carry out its usual day-to-day activities. Many SMEs, second one, many SMEs struggle to manage their working capital because they lack the resources to adequately manage their trade debtors. SMEs lack effective debt procedure such as timely invoicing and regular statement distribution. When negotiating financing terms with bigger businesses, SMEs will frequently find themselves in a disadvantageous position. The SME owners and managers are not always aware of the expenses of keeping too much stock as well as the cost of holding too little stock. It was also found that cash balance was generally proportionately higher for SMEs than for large businesses. Again, more than half of the SMEs had regular surplus cash balances. Working capital cycle. There are three phases to the operation cycle. We have already discussed this working capital cycle in one of the previous counseling sessions. Here we are concerned with specifically to the SMEs. Cash is transformed into inventory in phase 1, which comprises purchasing raw materials, converting raw materials into work in progress and finished goods, and finally transferring items to stock after the production process. This phase is shorter in trading companies that are usually modest in size since there is no manufacturing activity and cash is directly converted into inventory. Then in phase 2 of the cycle, inventory is transferred into receivables. In phase 2 of the cycle, as credit sales are made to customers. Businesses that do not sell on credit do not have phase 2 of the operation cycle, which is especially true for small and medium businesses. The collection of receivables is represented by the final phase. This phase completes the operating cycle, requiring business to transition from cash to inventories, receivables, and then back to cash. Or you may say that this working capital cycle differs from industry to industry and even in one industry from particular unit to other particular unit. Working capital goals for SMEs. The best basic goal of working capital management, whether it's small or large, is to maintain a level of working capital that maximizes the value of the firm's owners, shareholders. In addition, the following are some of the goals of working capital management. Working capital and the liquidity of the company are inextricably linked. As a result, good working capital management ensures that the company has enough cash on hand to meet its short-term obligation and run its day-to-day operations. There should be a link between profitability and working capital as well because of the cost of financing the firm's current assets. The amount of capital has an impact on its profitability and working capital. 3. There is evidence that many SMEs are poor at managing their working capital, which has been highlighted as a primary reason for their high failure rate when compared to bigger enterprises. Working capital management. If a company invests too much money in working capital, the quantity of money available for other business needs may be lowered because it does not have enough cash to invest in long-term assets that can provide high returns. This could have an impact on future profits. The best strategy to fund the working capital required is to use the cash generated from operating activities. This will ensure that you have enough cash to pay your tax and dividend obligations. Companies have the problem of expanding output while keeping working capital under control, which has had a significant impact on revenue, operating margin, assets efficiency, and future expectations, as well as the components of working capital. This is depicted in the figure. Shareholder value. Revenue growth. With revenue growth, operating margin will grow. Assets efficiency will grow. Assets efficiency means related to property, inventory, receivables, and payables. And then expectation will grow. This is a cycle. First, there will be growth in revenue. With the growth in revenue, certainly there will be growth in the operating margin. Unless expenses also grow more than revenue. And while operating margin will grow, the assets efficiency will grow. And when assets efficiency grows, expectation will also grow, and this will continue in a increasing order. Working capital management. There are no fixed norms or criteria for calculating a company's working capital. To assess the level of working capital, the company must evaluate a variety of elements. The amount of working capital required by a company is influenced not only by the company's internal characteristics but also by its economic, monetary, trading, and working capital regulations. Among the various factors, the following are important ones. The first one, nature of business. The type and size of working capital are influenced by the characteristics of the firm within the industry. For example, if the firm is dealing with trade, purchase and sale, the working capital requirement will be less. The second one is working capital policy. An aggressive working capital policy will boost profitability, but the risk will also rise if the likelihood of cash shortages or inventory shortages increases. Means if there is aggressive policy, means more business is done in less amount of working capital, certainly the profitability will increase. But at the same time, there will be chances of cash shortages or inventory shortages at any time. A moderate policy would strike a balance between aggressive and conservative policies. Third one, financing of working capital. The risk return trade-off that happens in policy decisions about current assets investment is also important in policy decision about other items on the balance sheet, such as the choice between short-term and long-term funds to finance working capital. And here the problem of risk return trade-off arises. As we have already discussed, in case of less amount of working capital, certainly there will be an increase in the profitability, but there will be a risk of shortage of funds. The fourth point is optimization of working capital. The following are the various barriers to optimize the working capital in small and medium enterprises. The first one is customer and rivalry. Fear of compromising relationship and revenue by pursuing customers for payment too aggressively. There is a chance you will lose clients to the competitor. Fear of drop in customer service if inventory levels are not kept high. Customers are granted payment discounts even if they do not pay on time. Longer payment terms are being offered due to competition. But all this will be a loss to the profit. Second point is suppliers. Concerns about how suppliers will react and the potential of disruption to supply as a result of a unilateral move to extend payment terms. If you extend the payment terms, say from 10 days to 15 days, it is possible that the customer will pay more and
कौन से पेज था सर? पेज कौन सा आ गया था?
पेज नंबर तो पढ़े ही नहीं मैंने।
पेज नंबर पढ़ेंगे।
पढ़े?
हाँ, स्लाइड कौन सी है ये बताओ मेरे को, कौन से नंबर की स्लाइड थी?
हम वर्किंग कैपिटल मैनेजमेंट प्लस कर रहे थे, हमारे ख्याल से होगा 25 6। हम कर देंगे।
वर्किंग कैपिटल साइकिल।
हाँ
हाँ,
नहीं, हम कर देंगे उसको, वहाँ पे आ जाएंगे। आप ही कर लीजिए, अब आई आपने लगा दिया ना, अब हम कर देंगे।
मैं लगा रहा हूँ, 2 मिनट दीजिए।
क्योंकि अब हमें ये बोलना पड़ेगा वर्किंग कैपिटल मैनेजमेंट से जैसे।
लाइट चली गई थी सर, बीच में बंद हो गया था।
सिस्टम ही बंद हो गया था। We were discussing this control and accountability. On account of power failure, we have disruptions. The importance of cash is not reflected in individual or organizational performance measurements. Working capital is a complex topic with multiple functional areas to which no single person can be assigned authority. Advantages. Are there any advantages? We will be unable to run the firm on a day-to-day basis if we restrict liquidity. Are the advantages long term? It can control working capital levels after the fiscal year, but they quickly climb again. Fifth point is small and medium enterprises overtrading. Overtrading is one of the issues that many businesses, particularly small and medium sized businesses, face. Overtrading occurs when a firm expands too quickly and does not have enough long term funds to support the increasing assets level. Overtrading impact reduce. To mitigate the impact of overtrading, it is recommended that the company maintain its growth strategy and take steps to secure the appropriate long term finance. The corporation can sell non current assets for cash to finance working capital if they do not create enough income and are not crucial to the firm. Determinants of working capital management in SMEs. The level of working capital is determined by fundamental elements which are separated into three categories: firm specific, owner specific, and behavioral bias. Firm specific factors. The first one is firm age. Older firm has easy access to working capital in compared to the newer one. Firm size. Those firms which are bigger in size, they can easily arrange working capital as compared to the firms which are smaller in size. Financial leverage. Firms with more fiscal assets may have lower expenses when raising capital to invest in current assets, and on account of lower funding costs due to greater fiscal assets, they may be able to invest more in working capital. Foreign sales. When compared to enterprises without foreign sales, companies with overseas sales place a greater emphasis on working capital. The export-oriented business find it easier to obtain bank funding because they have a higher likelihood of payback than non-exporting businesses due to better production and profit. Now the second one, owner-specific factors. Gender of manager. Though it is not correct or right, but it is considered that males are in a better manager as compared to females. It is wrong. It has been found that females are working sometimes in a better way. Take the example of Indra Nui. Education of manager. If the manager is professionally qualified, he will be in a better position to manage the firm. Experience of manager. Then third one is behavioral biases. According to classical finance theories, individuals are rational and make decisions based on predicted utility maximization. However, in real life situation where people are not completely logical, the truth does not match these expectations. Moods, emotions, personality traits, and other behavioral aspects influence their decision making. Components of working capital management. A typical manufacturing or distribution firm's current assets account for more than half of its overall assets. As a result, these businesses must efficiently manage their current accounts to achieve the necessary balance of profitability and risk. Now we will discuss these components. Inventory management. The corporation should aim to strike a balance between the cost of retaining inventory and the risk of missing out on sales. The goal is to lower the company's total cost. Potential consequence of stock out. When a company runs out of inventory, it risks losing sales and losing money that could have been generated through sales. If the company's product is specialized, the consumer may have to wait for it, which is less serious. If a company's products are homogeneous, buyers can simply locate them elsewhere, which causes the company to lose clients to its competitors. Economic order quantity. Economic order quantity we have already discussed in one of previous counseling session. Here, by combining the expenses of storing inventory with the expenses of acquiring the goods, this inventory management method determines the optimal order size. Economic order quantity depends on two things: the cost of order and the economy of higher order size. Just in time inventory policies. In recent years, several businesses have cut inventory expenditure by reducing inventory levels. The goal of a just in time purchasing policy is to reduce or eliminate the period between inventory, delivery, and use. Such strategies have been used in a wide range of commercial operations and necessitate a close interaction between the raw materials provider and the purchaser of other consumable components. To avoid production interruptions, the buyer seeks guarantee from the provider on both quality and delivery reliability. The second component of inventory management is credit management. If the credit worthiness of new clients is rigorously analyzed before credit is issued and is evaluated regularly, the risk of bad debts can be reduced. A variety of sources can be used to gather the necessary credit information. The amount of probable regular sales could be used as a reference to define the level of the credit investigation, keeping in mind the cost of analyzing creditworthiness in mind. After the customer's creditworthiness has been assessed and a credit limit agreed upon, the company should take steps to guarantee that the credit limit and terms of trade are adhered to. The customer account should also be kept within the agreed upon credit limit, and credit extended should be reviewed regularly to ensure that it is still appropriate. To encourage fast payment, bills and statements should be double checked for accuracy and sent out as soon as possible. The trade receivables management strategies affect a company's commercial activities in the following way. It is the influence of trade receivables management on a company's activities. Influence of company activities on receivable management policies, marketing strategies, and strategic growth. When a firm's products are highly specialized and in high demand, the marketing strategies might concentrate on these characteristics. In a market with homogeneous products, the term of sale becomes significant and discounts and credit periods are regarded as key marketing tools. When long credit periods are granted, trade credit cost and hazards rises. The firm will strike a balance between this and the benefits of more profitable sales. Allowing for a longer credit period will assist the organization in getting rid of slow moving or obsolete inventory. The industry influence. In general, businesses strive to conform to industry standards. A firm that offers lengthier loan terms than the industry standard can usually charge more. If the firm's credit period is cut shorter than the industry norm, it may lose sales or have to lower prices. It would be necessary to assess the additional cost of discounting versus the benefits of lowering loan cost. Receivables collection system. The three stages of trade receivables management are credit policy, credit monitoring, and credit collection, which we have already discussed. Protection against bad debts. Specific account insurance allows a corporation to protect essential accounts from default and can be utilized for significant clients. Furthermore, cash discounts may encourage early payments, but their cost must be lower than the total finance savings resulting from lower trade receivables balances. Any administrative or financial savings resulting from shorter trade receivables, collection periods, and any benefits from lower bad debts. Now, the cash management. The trade-off between liquidity benefits and cost is an important aspect of cash management. Making the cash collection and disbursement system as efficient as possible is the other half. Because cash is a non-profitable asset, the purpose of cash management is to keep the quantity of cash in hand to the minimum. Influence. The internal and external influences of companies' cash balances are detailed in the table. Internal factors and external factors. Internal factor is type of business. Some businesses have a consistent demand for their products throughout the year, while others have to change degree of demand and seasonal or cyclical revenues. Firms with cyclical seasonal cash flow on the other hand require effective cash management. External factors, the economy. The state of the economy has an indirect impact on cash holding. If the economy is weak, the company may have difficulty obtaining the necessary funds, causing the cash out problem to worsen. This condition may be manageable and not especially harmful during boom times. Profitability. Companies with cash must maximize the return on their cash investment. Cash management at a loss-making company focuses on balancing liquidity issue until cash flows are positive. The strategy should be a growing company demands capital at all times, which has implication for cash flow when the expansion is not properly financed and liquidity is a significant concern. The company is said to be overtrading. The capital structure chosen will have a financial impact. Interest must be paid on the debt capital as well as capital redemption. How capital is repaid is determined by the type of debt. Inflation. Working capital requirements will be increased during periods of high inflation. This is especially true when a company is profitable, as the cost of replacing a capital, expenses, and assets may outpace the cash generated by the sale of older things. Effective working capital management for SMEs. Many SMEs owners, managers in realty run their business through trial and error. They frequently focus on innovation and sales, but they are less strict when it comes to financial management, particularly working capital management. First one, reduce inventory. In the following way, organization can reduce inventory across the value chain. Enhanced forecast accuracy and demand planning. Second one, improved delivery and logistic concepts. Third one, optimize production processes. Fourth one, variance management. One technique to reorganize and narrow the assortment and focus on the most selling products is to reduce product complexity and carefully track the demand of products variant to find the low turning products. Customization of items should be done as late as possible in the manufacturing process. Second one is secure good credit terms. Credit terms must be handled properly by the business entity with its consumers and suppliers. It must ensure that it receives the largest payment term possible without jeopardizing its ties with them. Avoidance of early payments. Companies should not pay anything before the deadline. Payment conditions. Renegotiating with supplier is an excellent approach for finalizing the payment terms and conditions. Back-to-back agreements. Matching the due dates of receivables and payables accounts can assist organizations to avoid excessive supplier pre-financing and maintaining a positive cash balance. Avoidance of early payments. Companies should not pay anything before the deadline. Payment conditions. Renegotiating with suppliers is an excellent approach for finalizing the payment terms and conditions. Back-to-back agreements. Matching the due dates of receivables and payable accounts can assist organizations to avoid excessive supplier pre-financing and maintaining a positive cash balance. Impact of pandemic on small business. While there is a significant disparity in working capital performance between small, medium, and big businesses, COVID, this COVID-19 has had an even greater impact on small businesses' working capital management. The pandemic had a smaller impact on major businesses' working capital than it did on small firms. These businesses have more negotiating power and stronger processes and procedures, allowing them to track and handle cash and working capital more effectively. During lockdowns, there is a build-up of inventory, particularly for non-essential items, due to lower demand for goods. As companies take time to readjust their production levels to the changing demand scenario. As you have seen in case of pandemic, the consumer was interested only in the necessary goods. The income level was also reduced in some cases for the consumers. Therefore, in case of small businesses, the impact was higher as compared to the large businesses. That's all. Thank you. Namaskar. इसमें दबा दिए थे
लाइव चली गई थी ना, मैंने कहा पता नहीं